in this video, I'm going to go over 5 questions. The next 5 questions, question 11, 12, 13, 14, and 15. There is nothing to calculate in these questions. And I think it would be good if I just talk about the importance, the takeaway messages of those questions. But if you are struggling with definitions, I think, or getting more information, what those terms are, like preferred shares, I think the best way to address those things would be to use ChatGPT or your preferred LLM model. Okay, so what we want you to know, what I want you to know, I think what is important in question number 11, saving money. So I think one of the things that is maybe the trivial part is to, save in tax-deferred brokerage accounts. Why tax-deferred brokerage account? Tax deferral allows you to keep the money that you would otherwise pay to the government and let this money essentially work for you. So you get to retain it until you actually retire and pay this money. And while you are working, while you're retaining this money that you would otherwise pay in taxes, just delaying that already builds the capital. Okay, so the money, say whatever your tax rate, say 20%. If you would have paid this 20% of your money at the day every year that you receive this salary, you would essentially give this money to the government sooner, right? So we know that in finance there is time value of money. So just by allowing us to defer the payment of those taxes until we retire, the government gives us essentially a subsidy to our pension wealth accumulation, because we are delaying paying money, okay, delaying paying those taxes. And while this 20% is delayed, this payment is delayed until we retire, this 20% keeps generating returns that we get to keep once we retire, and we pay this 20% on the money that is going to be in our tax deferred brokerage account. Then we're going to transfer it to, say, our savings account. We're going to pay the taxes on that lump sum. So that is when we pay this 20%, but we get to keep the interest, the returns that it generated over this time. So yes. One more thing, when you talk to financial advisors, they often would say a phrase, what matters is time in the market, not timing the market. And I think that's very important. So you don't want to wait until your salary is high to make contributions. So you want to start as early as possible, because what matters is actually how long you invest for, instead of like trying to wait for the right point to enter, or wait until your salary is very, very high. It's actually beneficial to start as early as possible. That's the most important factor, instead of waiting until the strategy of waiting until the salary is high and saving higher percentage of that salary is dominated by starting early and letting the money work through compound returns for time, for many more years. Okay. So starting early to contribute to a tax deferred account. So that highlights 2 strategies. So deferring taxes and time in the market. Time in the market, not time in the market. That's not a good strategy. Okay. So very basic question about cryptocurrencies. Just testing if you understand that what this verification system works, how the keeping transaction accounting for transactions in cryptocurrencies works. So I don't think I have anything more to add to that than what ChatGPT would tell you. Let's talk about Ponzi scheme. So this question was based on one of the recent cases that was brought up at Wall Street Journal. Okay, so what the journalists discovered at Wall Street Journal is that there was this investment vehicle that was advertising themselves as guaranteeing double-digit returns. Again, it's in US dollars, right? So the journalists flagged it right away as a potential Ponzi scheme. And at the end, yes, they did discover that it was a Ponzi scheme, and the person is now has been arrested, the person running this company. Okay, so what triggered the suspicion that besides looking at the investment prospectus, even though the investment strategy might have been looking all right, so what triggered the suspicion of the journalist and should trigger your suspicion as well if you hear something like that, is that the guaranteed return, so they were claiming that there is absolutely no risk, was in double digits, while the interest rate on like the government securities, which is as risk-free as possible, they're not completely risk-free, but as risk-free as it gets, right? So that was less than 4%, while this investment scheme claimed to guarantee returns that was double digits. Okay, so I think it was larger than 30%. And so if you understand the way financial markets work, you know that returns can be decomposed essentially into two components, right? The first one is risk-free rate, which is the compensation for time value of money. And the second return is compensation for risk, which consists of the price of risk times the quantity of risk. Okay, there are many models that quantify this empirically. One of the most famous ones is called capital asset pricing model. But as a arbitrage pricing theories, APTs, or more kind of extensions of the CAPM into more factors, the ones that actually are used by quantitative hedge funds maybe contain 200 factors, but the main idea is that all of these models that are actually used to make financial investment decisions, the way we as finance professionals think about returns is always this decomposition that you have some time value of money, which is the risk-free rate, plus the compensation for risk. And that compensation for risk may be due to many various risk reasons, but that's all risk-related. Right? So the only way to earn high return above that of the, say, treasuries is to expose yourself to risk. Okay, and good investment strategies understand what kind of risk you want to get exposure and what prices you're gonna command for that. Right? Okay, so if you expose yourself to market risk in the United States, for example, S&P delivers you returns of about 10% per year. 4% is on average time value of money, and 6% is what we call equity risk premium, which is the compensation for bearing market risk. Okay. Now, when somebody tells you that you can get 35% or more without any risk, that violates like all the laws that finance markets are built on. Okay. So that's immediately a red flag. And I mean, obviously, in reality, that was a red flag, and the prosecutors took note, and this person who was running this Ponzi scheme is detained. But for your own sake, just no matter what country you are from, look at what the government securities command. That's as typically as risk-free as it gets. And if there is a scheme that offers you substantially higher return than that, that's most likely a Ponzi scheme. Okay, so again, the returns are always time value of money plus compensation for risk. And if somebody is offering you high return claiming that there is no risk, there is probably some risk that they're not telling you about. Okay, so question number 14, investments, financial investments and risk management. So this is a question about annuitization. So for example, in the United States, a lot of pensions prior to 1980s were defined benefits. So upon retirement, people would get a guaranteed amount of money per month until they die. Okay, so in that scenario, the employer and the government takes care of all the risks associated with investment and with longevity risk. So risk of living to say 100 years is actually considered a risk, even though it's a good risk, right? So we all want to live long. But from the financial standpoint, it's a risk that you might run out of cash, right? Out of your investment, out of your money. How do you finance this? Living until 100 years if you don't want to work for until you are 100 years old, right? So in about 1980s, companies started switching from defined benefit to defined contribution plans, which means that upon retirement, you have a lump sum amount of money, for example, $150,000, and then it's your job to figure out how to stretch that money until you retire, in retirement until you die. Now, studying the way that investors behave, at least on the US data, scientists find that very few people actually annuitize. So what annuitization is, you take this 150,000 and you go to an insurance company and you buy this pension, right? So you convert this 150,000 lump sum into monthly guaranteed income until you die. This way, you're essentially saying, insurance company, please insure me against my longevity risk, right? So in data, there are too few pension people retiring that take up this annuitization. Okay, so even though it is by far the most preferred way, kind of uh, from the financial standpoint, that's the most recommended way to deal with financing retirement. So it does not have capital risk, right? So if markets go up or down, investors are protected, and on top of that, that gets rid of this longevity risk, right? So people can not worry about running out of money in retirement. Okay, so annuity was the right answer here. Okay. Question number 15, that is about buying a fancy blender. Think about Thermomix. I don't know if any of you heard about that. So right before was Trump tariffs were about to go into effect, economists were estimating how is that going to affect financial markets. And indeed, a decrease in imports would strengthen US dollars. Okay, so what's the logic here? So if there is less import, means that US entities want to buy less of foreign currency than to use those foreign currency to buy the goods to be imported into US, right? So if those US entities want to buy less of foreign currency, they're offering less of US dollars to exchange for those foreign currency. So supply of this US dollars on the international markets goes down, right? So when supply goes down, the dollar strengthens, okay? So the estimates were that whatever the tariffs would cause, in terms of price appreciation, the strengthening of US dollar will cushion it about by half. Okay, so it's not going to be larger than the tariffs. So they're not going to offset the tariffs. They're not going to all of a sudden make the prices even better to the US customers, but they're going to cushion the blow of the tariffs by about a half. So the right answer was B. A decrease in imports would strengthen the US dollar against other currencies, but such change is unlikely to offset the prices. And again, by the most kind of optimistic estimates, that was supposed to offset about half the tariffs increase.